Welcome to FreightWaves Today. It is Happy Tuesday. Julie, welcome back to another show. Welcome our guests to another show. How are you feeling today?
I'm feeling good. We have great guests. I'm excited to talk about trailers. I love to talk about trailers. I'm excited to talk about pricing. We've got some great stuff today.
Trailers are the most important part of the whole freight. I mean, everybody thinks about the truck, but without trailers, nothing moves.
Oh, like I used to say all the time, like, trailing assets cost money too. Like, we've also bought those. We can't forget about they need to be loaded and moving and paying for themselves and generating revenue too.
And they have a much longer shelf life. But there's, historically working at a large asset carrier like both of us have done, is trying to find those trailers is always a pain because the systems never seem to know where they're at. Drivers get the wrong trailer ID. There's just all sorts of madness that ends up happening.
Yeah, don't know if they're loaded, don't know if they're unloaded. We'll get into all of that with Mark in a little bit.
We're going to talk pricing, our Capacity Now segment with RXO. We're going to hear from the Vice President of Pricing. No doubt that he's going to talk about how strong this market is and how strong tender rejections are. And of course, speaking of trailers, we're going to get into intermodal traffic because it is about the container, the box. Now, I'm sure that Dutch Fry, the head of Echo's Intermodal, will talk more about container on flat car versus trailer on flat car, but we are going to hear about what the state of intermodal is because it is a very important segment and it is absolutely doing well and has been. I also want to remember our friend Donald Broughton, who was an advisor to FreightWaves in our earliest days. Donald Broughton passed away sadly about 10 days ago at his home in Missouri. Our thoughts are with Donald Broughton's family as in this time of mourning. A really tragic story. He was quite young and was sort of an institution. Donald had a very set of provocative opinions on the market, but he was always someone that loved and respected the market, and people loved and respected him, and he was definitely on the journey. And our hearts go out to the Freight family and Donald Broughton's family specifically, who are mourning the loss of an institution.
Yeah, we'll hear a little bit about that news in the Morning Minute, as well as some other headlines.
We kick things off with heartbreaking news from the freight analysis community. Donald Broughton, the bow tie-wearing analyst of freight markets who spoke before conference audiences and television viewers, likely hundreds of times, has died. According to his brother Tim on Facebook, Broughton died suddenly at home on May 30th. Broughton was not known to have been ill. He had spoken to the annual meeting of the Transportation Intermediaries Association in mid-April and did one of his many CNBC appearances on May 12th, where he gave a bullish outlook on the freight market. Broughton founded his research firm, Broughton Capital, in 2017, serving as managing partner and focusing on trucking, freight, and supply chain analysis. His trademark in his many appearances was his bow tie. Longtime freight industry analyst John Larkin said, Broughton tried to use his intimate knowledge of freight transportation data to draw conclusions about the broader economy, and did about as good a job of that as anybody has ever done. Meanwhile, in the brokerage sector, aggressive consolidation powered by artificial intelligence is fundamentally reshaping the industry's economics. Cincinnati-based freight broker Fura announced Monday that it has acquired LG Logistics Solutions, marking the 6th acquisition for the AI-powered third-party logistics provider. Financial terms of the transaction were not disclosed. LG Logistics Solutions specializes in full truckload, less than truckload, and intermodal shipping. According to Fura, freight brokerage is one of the largest and most fragmented service industries in the country, with thousands of small brokers running on manual processes and heavy overhead. Fura's strategy is to migrate each acquired brokerage onto a shared automation platform that runs the repetitive work, so every business it acquires gets leaner and more capable than it was standalone. As Fura co-founder and CEO Jeff D'Angelo put it, when we acquire a brokerage, we don't layer on more cost. We put it on a platform where automation does the repetitive work, so the business runs leaner and serves customers better than it did on its own. Finally, the country's biggest brokerage is rolling out its next massive AI initiative designed to continuously optimize supply chains around the clock. C.H. Robinson is launching the Lean AI Engineer this month, a follow-up to last year's Lean AI Planner that now autonomously drives 92% of managed solutions shipments for its fourth-party logistics customers. The engineer continually assesses and audits a supply chain to find areas where possible problems lurk, where it is operating at less than full efficiency, and where fixes can be designed and implemented. According to Jordan Koss, president of C.H. Robinson's Managed Solutions Group, the groundbreaking innovation is that this runs continuously and holds historical data and current data at the same time, as well as the entirety of a network. The system can proactively identify patterns like a customer shipping 3 less than truckload shipments to the same destination in a week and recommend consolidating them into a single truckload shipment instead. Koss described it as a closed-loop AI system that will run continuously, improve the operation it's running, and heal itself when something breaks without an alert or a human noticing a problem first.
Julie, there's a lot of AI headlines today.
Yeah, I noticed that. I think that I'm wondering, I would like your take on, with the continued rise of AI, the continued conversation we're having around it in the organization, acquisitions, do you think that that's going to continue to pick up? There are going to be more acquisitions where smaller brokers specifically are going to be rolled up into largers and put on into these larger AI organizations and then put on their platforms to create those efficiencies?
Yeah, private equity has been chasing this. I've gotten a number of inbounds, probably 6 or 7 from private equity groups, large private equity groups too, it's not small, that have wanted to roll up brokerages into a platform using AI to, in their mind, mitigate a lot of the expenses. C.H. Robinson is, the public example of a company that's stock has been absolutely ripping because of the AI implementation. The question, I think, and some of the, I wouldn't call it detractors, but some of the people have responded and said, how much of this, in terms of C.H. Robinson's operating improvements, are AI specifically, or just basically taking care of a lot of sort of business deficits, operating costs that maybe should have taken out anyways. And so AI, is it the excuse? Is it the reality? I think probably answer somewhere in between. We are seeing private equity groups. There is a scale element. I do think with Montgomery is a catalyst. Yeah. It's going to be even more so because the companies that are able to demonstrate compliance are going to end up winning. The cost is going to go up. I mean, if you look at, so Dodd-Frank is a banking bill, and Dodd-Frank came out of the financial crisis, started to regulate banks, and the idea was that too big to fail, we need to consolidate, we need to manage the too big to banks. But what we actually saw was when you add regulation and compliance cost onto participants, the big companies can deploy that over a much larger set of revenue, whereas small companies still have to do the very basics of compliance. And so I think it's going to make it harder and harder for smaller brokers to be able to manage and migrate. And I think we're going to have a two-class system of large brokers, large scale, perhaps private equity roll-up AI businesses that are able to really build that compliance function and put it over a very large group of loads and personnel. And then you get sort of the riverboat gamblers that will take the risks and just say, what's going to happen? And then you end up with a chameleon broker. And I think that's going to be the outcome that we're going to see. And then those that perhaps don't want to be riverboat gamblers, but actually want to build a business of their own are probably going to become agents. Agent programs like you see at Armstrong or Worldwide Express, those types of businesses, I think, probably end up doing well because they can attract. Landstar is another example of that, where an independent business owner can come in and basically have the infrastructure, have the benefit of compliance technology, and not have to go out and sort of build that themselves.
I think that makes a lot of sense. But I think C.H. Robinson has absolutely been the poster child of AI at large scale at a large broker.
You figured out what investors want, right?
Yeah, and citing numbers like 40% efficiency increases since 2022. The lean AI has certainly been something I've been watching and interested in continuing to follow.
Yeah, so we'll see it. So now our next guest, we're going to talk trailers. We talked about this earlier on. Mark Wallin is the president and general manager of Phillips Connect. Mark, how are you?
Very good. How are you both?
We're doing great. Let's talk trailers. I mean, it's the underappreciated, perhaps most important asset in freight. It's how freight moves. Got to have the box. Mark, you guys are creating the connected vehicle, the connected trailer. Let's talk a little bit about what you're saying. What are fleets right now when they're talking about their trailer pools? How are they thinking about creating better visibility to the systems?
Yeah, no, you're absolutely right. Smart trailer has been one of those things that has kind of been forgotten, right? It's everybody focused on the truck, the driver, but now customers are talking to us about how can I make that trailer smarter? How can I make everyone around my operation smarter, more efficient, easier for them to work? And that's really what we've been doing and continue to help a lot of customers in that journey.
What is like when you are implementing, when a fleet's implementing your technology, what is it that you guys are initially doing? What problems are you initially solving?
Yeah, I mean, as you might imagine, initially everyone, as you guys even talked about in the opening segment, how do I find my trailer? Where is that trailer located? Is it being used? But very quickly, most of the industry and our customers have started to realize there's a whole lot more questions, right? So what's inside my trailer? Can I get visibility in there? Can I see it? But can I get insights? Is it the floor full? Is it partially full? Other insights that are very popular with most fleets on the smart trailer journey is around tires and brakes. How do I ensure my trailer is healthier, right? But they all start with this simple kind of problem of how do you make something more efficient and easier? And that's really what we've done for our customers, and we continue to do for all the customers looking at a smart trailer.
So it's clear that smart trailers are more than just telematics. They can give you all sorts of other data points and information. Can you give us some examples of that?
Yeah, for sure. You're absolutely right. A smart trailer is way beyond just the location, right? It is around creating insights. If we talked about like inside with a camera, knowing about the cargo, the doors opening and closing, are my tires healthy and able to operate efficiently? Do I have enough power in my lift gate? All of those sensors are part of the things that we monitor and is really probably the first layer of our smart trailer platform.
Mark, I imagine in a SCOTUS environment, post Montgomery, shippers and brokers alike are thinking about how do I underwrite the safety of this carrier? I imagine these technologies, while we're very early in that journey, I imagine that over time, the carriers are going to have to demonstrate that they are doing the things such as monitoring the health of their equipment to shippers and brokers alike.
Yeah, I think you're right. There is a huge trend in taking more insights and learning more about their trailer from a safety perspective. If that's making sure you're operating with good brakes on a trailer, if that's making sure your tires are healthy and aren't going to have likelihood for a blowout, it's important to know if your tires did blow out, how do you notify the driver? To roadside safety. We're doing a number of innovative things around roadside safety, such that when a trailer does pull over on the side of the road, how do we create greater visibility and greater safety for the driver, for that trailer, and then all of the people on the road around it?
Beyond just safety, I would imagine that can be also impactful when it comes to fraud and cargo security, since you can tell if the trailer is still loaded, if it's stopped in transit, if the cargo doors open. Have you seen examples of that being helpful?
Yeah, so definitely we're seeing a lot of that around theft, right? So as you imagine, you used to just hope that when the trailer left the yard, nobody got in, nobody entered. Now with sensors on the doors, cameras inside, ability to detect it's not even at a normal stopping location, our ability to let people know and help them actually fight a lot of that theft and fraud is really an important part of a smart trailer.
Mark, what can they do with it? So let's say that, these trailers are getting broken in. Everything going down the highway, there have been reports of that, or at least stopped in transit, that the trailer door is being broken, the sill's being broken. What does a fleet do with that data?
Yeah, so I mean, the first thing is that they equip their trailers to be smart, so we know the doors are open. The moment the door is open, we take a number of photos and then we transmit that to the cloud. And that's really then where organizations are still figuring out how best do I notify authorities, how best do I identify and really recover that trailer later, and how do I better prosecute and have actual proof of who broke in and what they did.
So where is the demand coming from for you guys? You've got a large install base among the largest asset carriers. How far downstream are you seeing fleets adopt the technology?
We're really just seeing the adoption across all types of fleets, right? So if it's less than truckload, full truckload, private fleets, understandably, it starts often with bigger fleets, but we're seeing even the smaller fleets are starting to really adopt smart trailer because really it makes the world and their lives simpler, right? Everybody in that organization is able to work easier, simpler, and safer. And that drives anybody to want to have better technology in their day-to-day lives, if that's the largest fleets or if that's a small fleet.
Are you also detecting the cube on the trailer, or is it strictly just the doors and the sensors, the tires, sort of the mechanical equipment, or is there actually the ability to perhaps weigh the trailer through some of these smart weigh technologies?
Yeah, so one of the areas we've been very focused, and it is one of the most popular features, is around understanding floor space, the volume inside of a trailer, and the utilization of that trailer, right? So using images and AI, we're able to detect if a trailer is 50% full or 100% full. And then this can be used for improving utilization rates, understanding better the strategic plan. We're even starting now to detect what's in a pallet. Is it an oversized pallet? Is it the right size? What types of objects might be in there? But there's a lot of exciting stuff that we're doing around just intelligence inside a trailer, which is a brand new space and far, far from just tracking a dot on a map.
Is it using optical equipment, LiDAR? How are you actually getting the sort of footprint of the cube of that trailer?
Yeah, so today it's heavily focused around images that are taken during the time the trailer doors are open, during loading events, during activity, and then using image recognition and models that help us break down a trailer into different parts, and then to be able to look inside and say, is that 40% floor space or 80% volume? And then that information is fed back to a dispatcher, fed back to a strategic planner, fed to an equipment manager doing the traditional yard check where they walk around and look at all the trailers every day. Imagine today, they don't need to do that. They just look on their platform and see all the trailers that are empty, what's inside, never leaving their desk.
I imagine that part is incredibly impactful. I certainly to have the images to make sure that you are fully utilizing the trailer space and loading appropriately, but then to also be alerted when a trailer is unloaded. So you're not doing those yard checks and you're not charging or not charging detention when you could be if the trailer isn't unloaded or you're overfull or underfull. Can you talk?
Keeping your shippers honest, because let's be honest, sometimes shippers say, hey, we emptied that trailer when they didn't.
That's what I mean.
Holding
You
them
can charge them trailer detention if it wasn't truly unloaded, or if they're asking for more trailers and you're saying, hey, I'm not going to drop in more trailers. You have plenty there. You need to unload the ones that you have. Those are all things that make money for fleets and make a difference in their day-to-day operations. So I think that's amazing. Can you talk about the implementation when your customers do choose to go with this product?
Yeah, I mean, from an implementation, it starts very similarly to any equipment that you put on a trailer. You can either do it when you're building new trailers and outfit it with all of your smart trailer, or you can take any trailer that exists in your yard today and we can quickly install the location tracking and various sensors, if it's tires, brakes, lights, a camera, and you're off and running, right? And then the second part is really how do you distribute that to the essential people in your organization, if that's to a driver in cab with our driver assist, if that's to a mechanic in the field with our tech assist, or our Connect One platform to everybody in the organization, they can all get access to a smart trailer insights.
As the industry continues to evolve and we talk more about autonomous freight, can you talk about how this plays a role in that?
You know, autonomous freight has been a very interesting kind of trend for us as a business, right? People have started to realize that when you remove a driver from your day-to-day operations around a trailer, there's a lot of things that was manually being done, right? And in autonomous, that's not going to be possible. So there'll be nobody looking to see if the doors are closed. There's nobody going to tell you if the trailer was empty. No one's going to tell you about the health of a tire, if it's low, if it's on fire, right? The door's open. You can imagine a lot of scenarios that an autonomous truck going down the road needs to understand what's going on with that trailer. And that kind of requirement is driving a lot of fleets to make that move sooner than later so that they have the essentials they need to be successful today in terms of more efficient operations, or tomorrow from an autonomous trucking perspective.
Mark, where are we at in autonomous? I mean, we've seen these pilots. People have been talking about driverless trucks for many, many years. Feels like we're in the very beginning stages of it. But from what you're seeing in terms of fleets, how prepared are they? And where do you think we're at in terms of stage?
Well, I can certainly speak from the perspective of a smart trailer, right? Organizations that have smarter trailers are more equipped to handle the transition to autonomous trucking. We're seeing and working with a lot of the autonomous trucking as they have continued to improve and master the ability to keep a truck on the road. They're looking at now, what do I need to know about a trailer? How is that going to be essential? How will I get that information? What's critical? And we've been a big part in trying to help that understand what do you need to know about a trailer and how would you receive that? So we're certainly seeing smart trailers becoming more and more critical as people look at the future, regardless of where you want to predict that future is today. Autonomous is really driving smart trailer and going to make smart trailer required.
Where fleets are really dealing with this, we're coming out of the Great Freight Recession. We had this report called a SITREP, which is really a situational report of the industry. We went and looked at conference calls of publicly traded companies, 72 companies in total. It was one of the companies was actually pretty bearish. It was Wabash, was the most bearish company connected to freight. I suspect it had to do with their debt downgrade, but I think just the general market for trailers seems to be weaker than the rest of the freight market. What's your read on that?
Yeah, it's one of those things that depending on some of our customers, it looks really great. They're building a lot of trailers and some are not. So it's really hit and miss, I think, from our perspective of where people are bullish. But we certainly know that most of our customers are looking at when they build new trailers or they utilize trailers, how do they make them smarter? How do they allow an organization, everyone that touches them, to have an easier, simpler, and safer kind of experience?
So we spoke a little bit earlier, you talked about autonomous trucking making this sort of a minimum requirement instead of a nice to have or a differentiator, creating efficiency. Do you think that happens prior to autonomous truly being a major mode? What makes this smart trailer a requirement for current fleets? Is it fraud? Is it cargo safety? Is it the SCOTUS ruling? Is it just the need for data as a whole?
Yeah, certainly companies today are all looking how to be more efficient, how to run safer organizations, right? And they're under a lot of pressure to do that, as you guys have pointed out, through a whole lot of different trends going on. And they've all decided that one way to make their organizations more efficient is to equip their trailers with the right information such that they can all have a more efficient operation. So regardless of where that organization starts, if that's from a maintenance and just saying, I want to reduce my spend on tires and make them last longer, if that's, I want to be able to dispatch 3 or 4 more loads in the middle of the day and I need to know what's inside a trailer, any one of those problems are all really around customers saying, I need to be more efficient. I need to be more operationally simpler and easier to be successful. And then that success will be today if I'm using a smart trailer, or that success will be something with autonomous. Either way, smart trailer today are helping organizations be more efficient.
I love seeing the box. The box actually get sensors, the box itself get smarter. It's so important in the future. I do wonder if autonomous is going to be eliminate the cab. What was the movie? Was it Transformers or one of the movies about the futuristic thing? Actually, maybe it was Wolverine, where they didn't even have the cab. It was just a box. So Mark, maybe that's where you're taking us into the future. Exciting conversations. A lot's going on. Mark, really appreciate you being with us.
Absolutely. Thank you for having me.
Thank you, Mark.
Well, up next, we're going to talk about LTL. Speaking of the box and speaking of Cube, LTL, Julie, is really important for trucking, and it is tied into the trucking freight cycle. We're going to hear about the freight cycle with RXO and the Capacity Now segment, the head of pricing, but we're going to talk about LTL first because it tells us a lot about the broader market.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
All right, welcome back. That was such a great conversation with Mark. I could have asked him a lot more questions.
You're a trailer nerd, aren't you?
Yeah, I really, not because I am mechanically minded, I'm not, but because I like talking about the way it impacts an operation, and I think it's an overlooked, incredibly important part of a trucking operation, and it matters to shippers, it matters to drivers. It takes a ton of their time, and certainly we're going to be in a tough retention and recruiting market, so having these sorts of tools will be helpful. But with that, we are going to get into the Sonar update and see what's happening with the Sonar data.
Couple of months, all eyes have been on the truckload sector to get a sense for how strong the freight market is, while LTL, and that's a small percentage of the overall trucking market, approximately 7% of the total trucking market is tied to LTL. Really, LTL has been sort of a sideline factor, not really getting a ton of attention. Now, it's true if you're a Wall Street investor that the largest companies in our space are LTL providers, so it gets more attention on Wall Street than it does for the broader freight market. But really, the attention has all been on truckload. We're finally starting to see the impact of tightness in truckload show up in LTL rate increases. ArcBest, one of the largest LTL providers, has announced a general rate increase of 5.9%. This is much larger than they have done over the past couple of years, and a sign that they're seeing significant improvements in operations and volume, and a belief that tightness in the trucking market is going to continue to show up and sustain itself, as well as really create tightness in LTL capacity. This has been something the LTL carriers have been wanting to do due to the very close and controlled market that they're in, but haven't had the opportunity to with weak trucking markets. In light of LTL provider Yellow's bankruptcy in 2023, there was belief that the LTL providers that survive would get a lot of opportunities for consolidation. Companies like Estes went out and bought an enormous amount of terminals, but many of the other LTL providers did as well. What we're seeing right now is more pricing discipline across the board. LTL companies are raising rates, and while they have tried to do rate increases over the last couple of years, they haven't been gaining a lot of ground. In fact, when we look at the annual pricing data, we've actually seen pricing slow down or actually drop related to all freight bills across the country. This is because while they may do a general rate increase of some amount, they also discount on the back end. Our data inside of Sonar, LTL.USA, does track this. It also includes fuel, so it's hard to really see exactly what's happening in the market and LTL fuel is quite different than truckload fuel. It's harder to strip out of the LTL data than it is to strip out of the truckload data because you have a lot of variables that are involved in that. And we don't really know the overall mix of freight that's moving, distance, and so forth. So it's harder to get a sense for how the impact of fuel is on the LTL providers. But suffice it to say that when we look at the data, we saw a significant increase during COVID. That was really in 2021, a sharp increase above where we were in 2020. Those increases were then really dropped a bit when we saw the slowdown in the Great Freight Recession. And then we saw another temporary spike right after Yallow's bankruptcy. The problem is it didn't sustain itself in 2024 and 2025, and only recently have we seen LTL pricing go back up. In fact, LTL pricing is currently at record levels. In fairness, some of that is fuel, and that's driving a little bit of the price inflation. But I do think it's interesting that the LTL providers are announcing these significant rate increases. A 6% rate increase, what we saw from ArcBest, is actually a pretty sizable number, much higher than inflation, in the sense that LTL providers believe that they have a lot of pricing power in the market. As truckload capacity tightens, that does help the LTL providers. They benefit from having available capacity. And as companies find it harder and more expensive to move truckload, they will look for LTL as an option. Over the last couple of years, some of the LTL volume made itself into the hands of truckload providers, but due to the cost increases in spot and contract rate in truckload, additionally tight capacity, that volume is headed back to LTL. And you can see this, and I think the most relevant data set is the Cass Shipment Index. We know the Cass Shipment Index quite well. We track it at FreightWaves. It's inside of Sonar. We have a close relationship with Cass. And what I think is misunderstood often is the Cass Shipment Index really is heavily exposed to LTL, even more so than truckload. In fact, as a percentage of the total transactions that flow over the Cass Shipment Index, LTL is more representative than the truckload market. It's not to say it's not important. It just tells us, in fact, it could argue that it's perhaps far more important because of what it tells us, not just the raw number. The fact that Cass's shipment index tells us that it's been dropping, but yet we see really tightness in truckload information is really what you would expect to see in the front end of a recovery, particularly in the industrial sector as the freight market comes back. And the reasons for this are pretty simple. Companies are getting higher volume in shipments and therefore consolidating what was LTL shipments into truckload, and therefore the number of bills, the number of shipments actually drops, but the weight or the volume, total quantity of things that are being shipped actually increases. It's a little counterintuitive when you look at the Cass Shipment Index because you initially look at it and say, man, things are really bad. But then when you look at the broader truckload index data, you realize that things are actually quite good. And that's why it's important that every single data point that we take into the market is not looked at exclusively, but looked at in context. That is something we do at FreightWaves pretty extensively. We publish 4.5 million data points a day. We have thousands of different types of data points. And it's hard to draw one conclusion by looking at one data set about the freight market. You have to look at it in context. It's something we do pretty expansively. We do a lot of channel checks. And this is what we're seeing is that the broader freight market is increasing and accelerating. Industrials are starting to come back online and doing well. Retail has been holding its own. And we're starting to see that the LTL providers now believe that they have pricing power. And we're going to see increases in LTL pricing as we go out through the rest of the year.
Great update. Let's talk about LTL and what's showing up there, and if you think it's consolidation of truckload volumes or what's driving it.
Look, as I point out in the morning video that I do, is it's a combination of a couple of factors. One is it's just tightening capacity. You know, when truckload was really soft, shippers could put out what would now be LTL, or traditionally be LTL, into truckloads, and they were sort of taking advantage of having the direct shipments. I mean, when you haul things through LTL, you're always going to have more claims. You're going to have more damages. Things get misrouted. You know, forklift holes get put in your stuff. It happens, even with the best LTL providers that are out there. But now shippers are taking advantage Well, they did take advantage, I should say, during the softness of the market. LTL, yes, correct. WebAS just pointed it out. But now the LTL carriers, as they're seeing volumes come back, are doing general rate increases. They haven't been able to do, they've had some rate increases. They've announced rate increases, GRIs, as we would call them. But when you look at the data, really, LTL pricing did not significantly increase. Let's pull this up real quick because I think it sort of shows it. We saw in 21, we saw it peak. Then the freight recession hit in 22. There was you can see that in the middle, that sort of mountain top where it shot up. That was right in post-Yellow during their bankruptcy and shutdown. And I think it just didn't sustain itself because there was so much excess capacity in truckload that LTL guys just couldn't get the pricing. But now they're getting it. We're seeing it in the data. LTL prices are at record highs. A little of that is fuel. LTL companies have fuel surcharges. It works a little bit different or a lot different than the truckload fuel surcharge, but it is showing up there as well. But tight conditions mean you're running out of capacity. And what happens when you run out of capacity? You turn to the LTL providers, or you call up our next guest at RXO for Capacity Now. When you are needing freight and you need capacity and you need it now, I feel like Jay-Z, you guys are the Wentworth, what's the commercials? Need cash now? Need capacity now. How are you doing, sir?
Hi, Corey.
Hey, Craig. Hey, Julie. I'm doing well. Hey, I've been tuning in to the new segment over the last week, and I've been really enjoying it. So congrats to the success and happy to be a part of it.
Well, Corey, really appreciate what you're doing for our industry. You're the Vice President of Pricing at RXO. Drew has talked, your CEO has talked extensively about tender rejections, how important that is. But really for shippers, this puts them in a bind when carriers are not maintaining the routing position, they're rejecting freight. Everyone needs an outlet. What are you guys seeing right now?
Yeah, we're seeing exactly what you've been hitting on over the last couple of weeks. I mean, tender rejection rates and the way that we think about risk management, and really importantly, the way I think shippers need to think about risk management is an important key metric for what we're seeing on contract rates that were potentially established at a time period when rejection rates were a little bit lower. And then when you start to see that acceleration and some of that low volume freight that might have been tied to a contract from months ago is now starting to come online and starting to potentially go through the routing guide, that's the business that's really starting to see those rejections rates elevate and move higher. And I think that's where that data and that metric is really important to measuring how much business is going to spot and what that risk is for that business on the routing guide.
Absolutely. I think that you're definitely right. What are you seeing, though, from a contract rate standpoint? Are you seeing those rise as well?
Contract rates are starting to react. I mean, we have been very adamant about the relationship between contract rates and spot rates, and the way that we think we measure spot versus contract, either premium or discount. And using the curve, the proprietary curve that we use to measure the way that spot rates are reacting or pushing contract rates, there is a strong correlation that contract rates start to move and react to spot rates accelerating about 3 to 5 months later. So if you think about the weather that hit in Q1 at the end of January, you think about that sustained kind of period of elevated rates in February, we're starting to hit that 3 to 5 month rate. And we really expect for contract rates to get elevated and trying to catch up to spot rates to make sure that routing guides are compliant with what was established previously.
Now, we've seen Q2 significantly hotter than Q1. You mentioned the curve. What do you see for the rest of the year?
I think we're going to see much of the same. I really think when you think about what's going on with the supply side in this market and what's really come out over the last couple of years and the regulations that have hit over the last couple of months, we're going to see continued acceleration between today and the rest of the quarter, right? You think about getting to July 4th, you think about getting to end of quarter, end of month, and that food and beverage push. And then I think we're going to see a little bit of seasonality return to the norm potentially in July and maybe a little bit of reprieve in August. But that peak season heading into September and beyond into Q4, I think is going to continue to be elevated given the challenges that are on the supply side.
Corey, how surprised have you been about how just this market, we talk about how fast the market has contracted. Has that caught you guys by surprise, or did the curve predict this?
Yeah, I think the volatility, Craig, it's a great question. I think the volatility of how this market moved over the last couple of weeks was a bit of a surprise. I think there was outperformance. Now, when we started to see things change a little bit towards the end of last year and January of this year, I think we had an idea that we would see acceleration beyond the normal seasonality, but we've been a little bit surprised on that volatile move. And in fact, I have continued to kind of say this for us, Road Check Week a few weeks ago, that was one of the top 3 largest week over week cost per mile changes as a percentage that we've seen since we've been tracking the curve data back many years. So that movement was a little bit surprising. And I think really, talking with shippers and, yourself and others included, the hard part here has been, it's been in a relatively soft demand backdrop. So that's what's hard to kind of decouple this volatility on the upside versus a soft demand on the consumer side, right? On the consumer, maybe staples, right? We've got industrial side and some green shoots there. But I think that's been the difference or the outperformance and expectations that has been a little bit of a surprising move, at least on my end.
Yeah, I mean, when you refer to cost per mile, you're referring to what the shippers and brokers are having to pay for capacity. It's gone up. Certainly, carriers are benefiting from that. They've had a brutal couple of years. I imagine, tighter markets is really anybody who's selling transportation services good. You guys have been very, again, the idea that shippers are going to need last-minute solutions, are going to need capacity solutions. How is it that they best reach out to RXO if they need last-minute capacity?
Well, we're always available. We have reps that are tied to our shippers and our contracts, but you can always visit rxo.com and push through. There are representatives that are always available to be able to take in an intake of a rate, a shipment online, or calling our 800 number to reach a rep. But yeah, very important. Those relationships are established. They're built. And we're ready to execute on the capacity that is needed to be able to push through on the supply chain side.
Corey, really appreciate you being here. The curve is an institution. It is something that we look at FreightWaves. To just channel check is also to validate the stuff we're seeing, and really, important to get enough data. I always say and tell people, you can't have enough data in this market, and the curve as an institution is a really important barometer of market conditions, as well as what is likely to happen over the next couple of months and even years.
Well, appreciate you saying that, Craig. We're going to continue to put it out, and it's readily available anytime that anybody needs an update. Please feel free to reach out to me, but I know we'll be a regular on the segment, so we'll be pushing that data out and coupling it with the Sonar data. So really happy to be able to participate in that.
Appreciate it, Corey. Thank you so much. Best of luck to our shippers. Best of luck to our carriers. I don't know that carriers need a lot of luck right now. Markets are taking care of them, but best luck to shippers. If you run out of, I keep thinking of the J.G. Wentworth. You remember those commercials? Need cash now? Really annoying. I don't know that RXO wants to do that, but if you do need capacity, RXO is here to help. They have the 911 capacity operators for capacity now. So if shippers are looking, your normal providers can't provide or won't provide, that's who you should call to get your spot freight.
All right, we're going to take a quick break, hear from our sponsors, and be back with Matt McKinney, the founder and CEO of Loop. It's National Safety Month, which makes this a great time to ask how your fleet can prevent more accidents. Samsara AI detects risks in real time, giving teams more visibility into what's happening on the road and more context to coach drivers before risky moments become incidents. Fleets using Samsara Complete AI Safety Solution have reduced crash rates by nearly 75%. See the data behind the results in the Samsara Safety Report at samsara.com/freightwaves.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
map is changing. As global uncertainties rise, the future of the supply chain is moving closer to home. Welcome to the new coast-to-coast North American network, driven by massive reshoring trends and next-gen industrial innovation, optimized by AI workflows that build unshakable operational resilience, and locked down by proactive security against evolving freight fraud. Are you ready to navigate the shift? Join the industry's top minds to build the future. The FreightWaves Domestic Supply Chain Summit, streaming live June 17th. Register for free at live.freightwaves.com.
Welcome back to FreightWaves Today. We are just having an amazing show, and we're going to continue this with Matt McKinney, the CEO and founder of Loop. Matt, how you doing, sir?
Good to see you, Craig. How are you?
I'm doing fantastic. It is that time of year. It's summer here in Tennessee. We got World Cup coming up. You're in San Francisco. What's the weather like there?
It's cold and gloomy. The San Francisco summer.
Not great, but it's not gloomy in the freight market. Things are heating up. You are helping companies, Loop helps companies pay their bills, which is a really important thing to do. But you just recently announced a Series C. Tell us about who you raised from and what you intend to do with the money.
Craig, I couldn't echo that more. I think at least in my career, it's the most exciting time ever to be in supply chain. You've been in it much longer than I have, but it feels like the energy, the momentum, it's all here. You got reindustrialization, you've got all these different macro factors that are happening, it feels like daily. And what is here in America is here to stay. And it's just exciting to see the market turn, but also just the build out of American infrastructure with not just new capabilities on fab side, but also new capabilities on all these token factories that are coming online.
You've been involved in freight. You were at Uber Freight before. You saw the opportunity to really improve the payment flow for the industry. Tell us a little bit about really the idea and concept behind Loop.
So exactly right. We were at Uber, my co-founder and I, Xiaosu, we were on the engineering and data science team. And a lot of the challenges that we had there were in the back office, but no one wanted to touch those problems because it had insanely messy data. And we quickly realized that we want to solve things like invoice reconciliation to help carriers get paid on time. Then we have to solve the underlying data problem. And what we found is that 60% of supply chain data is offline data. It's trapped in PDF, it's trapped in email, it's trapped in spreadsheets saved locally. And if you really want to automate a lot of this back office, you actually have to structure and organize the supply chain data, which, by the way, before LLMs was structurally impossible. You didn't have enough labor to actually go and organize this data. LLMs are amazing at taking unstructured data and structuring it. And so we saw this event as a moment to go automate the back office, starting with Freight Out & Pay and then expanding from Freight Out & Pay into other supply chain use cases.
So you just raised $95 million. What is it you guys intend to do with the business? Is it acquisitions? Is it organic? Where does the money go?
But the main piece here is the customers that we have, right? The most important suppliers to the AI build out. They are craving AI solutions. They've got on one side the cost pressures, the inflationary pressures that everybody feels today, tariffs, war, energy, rising prices. On the other side, they've got rising expectations of their customers. And so they're really caught in the middle, and they're asked to do more than ever today, and they need partners that can actually deliver the promise and the proof of AI that they know is out there. And for us, we saw this as a moment to really lean into that, to go and raise capital from Valor Equity Partners. And Antonio Gracias, who joined the board, he's lead investor at SpaceX, and he saw this as the real moment with reindustrialization in America to go back. Companies like Loop that are building out a lot of this core digital infrastructure and making this possible. And so for us, it was, hey, this is a moment to go and pull forward a lot of the innovation that we looked at over a 3-year product roadmap and compress that into 1 year, just given the demand in the market.
What is the biggest opportunity when customers are inviting you in to do business to help solve problems? Where is the sort of first place that you guys start?
I would love to say it's something very sexy, but the number one pain point that every single customer of ours has is they don't trust their data. And I was actually with the CFO of a large retailer last week, and he said that, how am I supposed to trust AI agents if I can't trust my own humans with the data? Because supply chain, you've got all these different sources of data that could come from your supplier, could come from your carrier, could come from your own internal systems, and no one trusts what version of that data it is. And so we recognize with our customers, if we want to go solve a lot of these use cases downstream, like workflow automation or decision intelligence, you actually have to first start with mapping the organizational data so that they actually trust the data. And that is the foundation that every single company we enter with, we start there and then build use cases upon that data set.
So you've got the payment, you're helping companies manage payment. There's this concept of financial operating system. I often think of what Intuit does for small business. There's an opportunity to do inside of supply chain. Is that the direction you see Loop headed in?
Correct. I mean, the cool thing about payments is it's just data. And you've got a ledger and data on the ledger. And so when you look at that, with a category that we started within, which is called Freight on Pay, it's a legacy service category, they were sitting on the richest data because they had all the financial data. And so for us to go map and organize all of the supply chain data, if you go start with the hardest area, the financial area that has all of these PDFs, bill of ladings, the proof of deliveries, the service delivery, all the things that you have to do to verify that that invoice is actually correct and should be paid, that's the richest data set. And so by organizing this, you actually build not just a payment network, but you actually build a data network that can help power the entire supply chain.
So Matt, I imagine one of the things here that you're trying to accomplish is quicker, clearing payments quicker, processing invoices quicker. I think I've read it's on average 50 days. What do you think is a realistic time frame to get to?
Well, our vision is that the same way that you go to Starbucks coffee and you get your coffee and Starbucks gets their money, that happens instantaneously. That should be the default for supply chain. Now, of course, there's payment terms and trade terms, but the administration that goes into clearing an invoice, I think it's 12% of the cost is actually going to admin and AP and AR. That's a tax. And that's a tax not on the carrier, that's not a tax on the shipper, that's actually a tax on you and me as consumers, because at the end of the day, we are paying for that. That inefficiency is a tariff that we are paying for as American consumers. And for us, we look at that and we say, we should destroy that. We should destroy that inefficiency, and we should make the clearing of a freight invoice as easy as the clearing of your transaction at Starbucks. And by doing that, you're actually able to shift from a very high cost of capital participant, which typically are carriers, to a very low cost of capital participant, which are typically shippers.
Yeah, I mean, 50 days is almost 1% equivalent of cost of capital. What is as you go in and implement Loop, what is the cost savings that a company will see on average?
Well, there's three large ones. The one that I think is the most important is just freeing your people up, where you don't have all of these manual tasks being done by humans. You have them being done by agents. And one of our customers said it really well. Luke turned my team from processors to analysts. And so that's, if you believe that your organization is filled with amazing people, which most organizations are, then by unlocking their time, you're able to put them to higher value tasks that are going to create more economic value for your organization. So that's number one. Number two is actually, by having all of this data, you have a compliant data set to actually pay. You're not overpaying, you're not underpaying, you're paying accurately and you're paying on time, on term. That is very, very valuable to managing working capital, but also to managing risk. And I think the third, which builds upon that data asset, is now that you've got your team turned from processors to analysts, you've got accurate and compliant financial data, how can you use that data, not just for accounting and treasury, but how can you use that data upstream for things like planning and things like forecasting? And that's where we see a lot of our customers look for improvements, not just in their financial data, but actually in their operational data, where they now are finding one of these manufacturers, Fortune 200 manufacturer, said, I didn't know what I didn't know. And now Loop turned the lights on, and I found someone that, a factory that is hitting the overnight air button every Tuesday because 4 years ago they were told to hit the overnight air button. And when you look at the inventory levels, they've got a year's worth of supplies. So it's really those levels of operational insights by doing steps 1 and steps 2 that you unlock with step 3.
Matt, why does it take so long to issue a freight bill? And 50 days is ridiculous. Even at US Express, we were better than most, but it was still 2 weeks. That whole concept, I was asked that when I described how long it takes to just bill. People are shocked by how long it is. I don't know. It's like a mystery that maybe you figured out.
It starts with the data. The underlying data asset, when it's unstructured and you've got different versions of the truth, you need a third-party adjudicator to tell this is accurate or this isn't accurate. And so for us, we said, hey, we raised our hand. We'll be the third-party adjudicator. We'll organize the data so that we can automate the clearing of the transaction. If you've got the data organized and you've got preferences collected before the transaction actually happens, then you can actually clear the transaction instantaneously. But what happens is most of the time, you don't have preference codified, you don't have data organized at the time of the transaction. And that's what contributes to the congestion and the friction in actually clearing a freight transaction.
And how does Loop bring that together? How do you help companies speed that process up? What's the actual mechanics of that?
Well, first, it's taking all of the different disjointed data across suppliers, across carriers, across their shippers, TMS, their ERP, whatever data assets they had, email, EDI, PDF, just think of us as the pipeline that takes all of this data in from all these different sources. Then we organize the data based on their business policies, and then we execute the transaction based on those business policies. And so it's a very simple process, but to do that at scale, reliably, consistently, that is where the challenge happens.
You are a founder, you're in sort of the epicenter. It feels like San Francisco is back. AI and language learning models are driving that. You've been in this business as a founder for a couple of years, sort of the tail end or the COVID cycle, the tail end of SaaS, the SaaS apocalypse. What do we describe what's going on right now? How hard was it for you to raise capital? How challenging of that was it this time around? And what advice would you give other founders that are sort of setting their journey out where you were a couple of years ago?
My advice is play where others won't. I think what makes Loop so special is that we play the game in hard mode. When we started Loop, SaaS was the most popular, hottest thing in Silicon Valley. And Freight on Pay inherently is a service. And we said, we actually want to go do that. We want to do services. And a lot of the investors said, why would you go do services? It's lower margin, it's much more painful, it doesn't scale as well. And we said, well, it's actually the reason why we're going to do it is because it's hard and because we actually create value for the customer this way. That narrative has shifted over the last 5 years from everybody into SaaS now to everybody into services. And so the frontier for software is actually in services. And I think that ethos of just doing the hard things, going where others won't, builds a durable advantage for your company, but it also means that you're going to create unique value to your customers. And that's something that's paid off. And I think the last fundraise, the one that Valor led, we were rewarded by doing those things, not yesterday, but years ago, that built our advantage today so that we can go execute for our customers, continue to raise capital, continue to create value for our shareholders and our customers.
Do you believe that valuations in terms of service businesses, because we were founded in 2017, and the worst thing you could tell an investor was professionals, the words of professional services. First of all, media might have been worse, and I don't know that that's changed any language learning models are hurting it, but we'll put that aside. Consulting, professional services have gotten sort of a bad mark, particularly during the SaaS acceleration and peak. Is that changing? And what I'm hearing is that now that's more in vogue, that investors are actually excited about investing in professional service businesses?
Well, Craig, I think OpenAI like media businesses. They bought the TV.
Hey, look, if Loop wants to write a $200 million check, The offers, frankly, anybody wants to write a $200 million check. The offer's open. And I'm not talking about the data business. I'm talking specifically media. You can have Julie and I specifically just for Loop.
It sounds like a good deal. I think we should go market that.
Is that a deal? Is that a verbal contract, as they like to say?
I think Loop plus Anthropic, we would have a buyer.
Fair enough.
Everybody needs a media company now. So, and I think that, you look at the scarce assets, like, for example, media companies in specific areas where they've got unique distribution, you're going to see valuations of those assets continue to climb. And same thing with services, right? Where services companies, they have all of this tribal knowledge captured in unstructured workflows. And for LLMs, the next frontier, these large frontier labs, the next frontier is the data that's not online, because all of those models have been trained on internet data. The actual enterprises that we know and work with every single day, they have their own data, they have their own policies, they have their own unique domain model. And for us, we looked at that and said, services is where all of that data lives. And so if you can actually capture the decision traces and that lineage all the way through, not just what did the person do, but how did they do it? Why did they do it? All the way through. And that is your actual training set. And I think that Silicon Valley realized that. I mean, Sequoia put out an article around, services is the next $1 trillion opportunity. And I think that might have underestimated. I think services might be the next $10 trillion opportunity when you just look at the amount of money spent. I think just on business services alone in the US, it's $5.5 trillion. And so if you look at the amount of money spent on services that's delivered through human labor that will shift from human labor to tokens, I mean, that is the whole opportunity that Silicon Valley is excited by. And I think the investors are more than excited about entrepreneurs that are going after these hard problems in services.
Well, I mean, so many startups in freight sort of, plateau at some point because particularly if you're selling into brokerage business, there's just a finite number of logos. And you only get a very small piece of the value that you create. To your point, services, if you can automate the technology to do things that humans were doing or make them more efficient where they can do more, just the value creation is much more substantial than selling a piece of software. I know that. I mean, that's just the way that this works.
Yeah.
It's funny, Matt, you mentioned someone wanting a media company. There is a prolific founder, we'll call him, in the space that actually reached out to me not too long ago, a couple weeks ago, wanting to know if FreightWaves was for sale. I said, look, there's a price for everything. We're not for sale, but we're always happy to have a conversation. But to your point about services becoming super hot, where does this end up in 5 years, 10 years? Do we see companies like yourself doing a bunch of organic acquisitions of services businesses and then putting them on your platform? We heard about earlier today about a logistics roll-up that's actually using AI to do that very thing.
I think it gets exciting because the underlying value prop to the customer is the company that has more data can deliver a higher quality service. I mean, that service delivery is probably better, faster, cheaper. And so the belief that you can go scale with customers with more data, I think is the underlying assumption that has to be true to make an inorganic strategy where you're acquiring services businesses to actually be true. I think that the view on technology is that technology is no longer the limiting factor. I mean, I remember when we were contemplating, do we build audit software for services companies to use, or do we sell an audit, right? Those are very distinct. One is very clearly SaaS, one is very clearly services. And we actually said, if we believe the technology quotient is real, then let's sell the service, let's sell the outcome, let's sell audits, because that's what the end customer, that's what the shippers of the world want. And I think that is an example of playing the game in hard mode, because it's very clean and elegant to just go build a service wrapper with, or a software wrapper with no humans touching anything. It's just like, we'll outsource that problem to a service provider and they manage all of that. And so I don't think that is the truth anymore. I think that you've got to do more than just an elegant software wrapper, because the marginal cost of developing software is approaching near zero. And I think over the next 10 years, it will approach that even further. The services, though, the touch, the value, the hard, messy stuff that, quite frankly, most people don't know how to connect the dots. And I think that most people won't know how to connect those dots for the next 10 years because of how hard it is. That's where the value is going to live. And that's where we see all of our opportunity living. And whether that's, an exciting new service category that you want to go inorganically, or an exciting new service category you want to go inorganically, I think that that's just a question of what's going to create the most value for the end customer.
Matt, thank you so much for coming on. Best of luck with as you guys figure out what's the next step for you. Would love to have you back and get an update from you in the next couple of weeks, just as you guys develop and get more traction. We'd love to hear how you're investing the money and scaling up the business.
Yeah, likewise, Craig. I really appreciate you having me on the show. Congratulations on this new segment. It's so exciting. I think it's just a perfect time for this as the industry is so hot right now.
It's a bit look, you're right. I mean, the industry is absolutely hot. And Julie, I would say that we've had fantastic conversations. Matt is a really interesting founder, sort of authentic founder. You can tell that he's super passionate about what most people would view as a boring problem.
No,
that's where the money's made in the niches.
And two great takeaways. One, he kind of insinuated you were old when he said you've been in the business much longer than he has.
It's true.
And you always try to make me your age, so I love it when anybody else tries to make you older since you try to make me older. And two, I'm gonna use this later. Inefficiency is a tariff on consumers, and it's so true, and it applies other places as well.
Yeah, well, fantastic conversation. We appreciate, his comment about I was at an event last week, and it was at Google's headquarters, and there was a bunch of media executives in there, big names of some of the influencers, call it the influencer people. And what they're finding is that consumers that are looking for product reviews will go to the language learning models, the Chat GPTs and Claude and such. They'll do their research on what's the product, but then the authenticity of going and hearing humans talk about it. So what they'll do is they've narrowed it down between 2 or 3 products to sort of have an understanding of the specs, but then they want to actually have a human authenticate, and they'll go onto TikTok. And it was really interesting to hear this presentation about the shift where human touch, human influence is far more important, where everything else can be written by an AI. And that's I think it's a really profound time in history. And I think what Matt's doing is really smart, is going after the value that is not just the technology, but hey, how do we really automate a lot of this workflow to improve the value for our customers? As you said, it's a tax. Well, up next, stay with us. We're going to talk intermodal with the Vice President of Intermodal Business Development at Echo Global Logistics, one of the largest logistics firms. They just did a massive, massive transaction. We'll hear a little bit about that. We'll talk about the state of intermodal in the world, where transcontinental intermodal may be a possibility.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me, and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited, and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse? What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
All right.
Welcome back to FreightWaves Today. Man, I was enjoying the music. I was like enjoying the music, chilling. Good job on the production team of putting some cool music in there. Next up, we're going to talk Intermodal with Dutch Fry. He is the head of Intermodal for Echo. Echo is one of the largest freight and logistics companies in the market. Echo got its start really in LTL, moved into truckload, and most recently with this acquisition of ITS, has really scaled its intermodal offerings into multimodal. Dutch, welcome to FreightWaves Today. Happy to have you here.
Thanks, Craig. I appreciate it. And Julie, too. Thanks for having me. Wonderful show. Congrats. I love the format. Thanks for having me on.
Well, so much to talk about. I mean, the news is continuing. You guys have been a big source of news in recent months. Your acquisition of ITS. Tell us a little bit about what brought that along and what are you hoping to do with the ITS platform?
Yeah, still in the infancy phases of it. It just right now, extreme excitement about what's gone on to bring the two companies together. You know, what the future holds, we're all excited about. But given the infancy phases of it, right now it's just jubilation is what I would tell you.
Now, I'm detecting a little bit of a northern Midwestern accent. Where's home for you?
Yeah, I'm from originally Central Illinois, Chicago now, as you can imagine, like most of the freight world. And so, if you notice a palpable tan, it's a lot of soccer games outside and answering demand questions as it relates to intermodal.
Well, Chicago is an amazing city in the summer. Julie and I have said this. It's the best place in the summer to be. Salt Lake City is also a great spot. ITS is a Utah-based company. What are you going to do? Go out there in the winter and ski and the rest of the time and send summers in Chicago?
Well, you're going to have to talk to Doug or Dave about that and maybe get me out. I think they're in Reno, but I would maybe rather go to Reno. A few more things happening in Reno. Not there's anything wrong with Salt Lake City at all. God bless them all. But either way, like I mentioned earlier, we're at the beginning stages of this thing, and right now it's really just excitement. Two wonderful organizations combining forces to more adequately serve clients. Right. And that's what we're trying to achieve.
I should have known that. But I think mountain towns, Salt Lake City and Reno, are both amazing mountain towns. So, what is the goal?
Midwesterner. I wouldn't know the difference. Midwesterner.
Well, I used to dispatch trucks out there and we had a terminal in Salt Lake City. But what is the goal? You've got this massive infrastructure now. Echo's really leaning into intermodal. How are you going to serve your clients better with the ITS transaction?
Yeah. From relatively speaking, I think that we have highly competitive capabilities, complementary capabilities, drop trailer capabilities, dedicated capacity, obviously intermodal, container management, a host of other things. I think you combine those things with Echo's advanced technology, the automation that we have, the way we're expanding the use of AI, like is a hot button topic right now. In my mind, I think it strengthens our ability to deliver more reliable solutions to our clients and really scale effectively for them. So that's where my mind immediately goes with the acquisition.
So speaking of scaling for your clients, let's talk about intermodal demand and what you are seeing in the market if shippers are starting to shift from a truckload first choice to intermodal and moving their freight that way.
Yeah, gosh, that's a great question. I think that comes with a little bit of a story. We all know post-pandemic era came with these sort of recessionary times, and that came with low truck costs and static fuel for a long period of time. What we've really seen recently is and by the way, those pressures sort of didn't really exist up until Thanksgiving or around that point in time, which coincided with budgeting season for a lot of shippers. And so as we think about traversing 25 into 26, those pressures really started to afflict clients post-holiday season and then persist through the year, not only because of that constraint on the driver side, so the labor shortage for over the road, but also now with the conflict in the Middle East and the rising cost of fuel that has really sort of exacerbated costs for those folks who set the budget back in Q4. And so as we traverse the first part of the year, we'll say the first month of the year, demand was slightly up, if not negligible. It wasn't until really, weeks 5, 6, 8 through today that we're seeing this acceleration in demand for intermodal service. And to my knowledge, from what I'm hearing on the street, is most of the providers that are out there that have assets have unstacked those assets as they maybe sat stagnant or couldn't find the optimal route for them during that recessionary time. All of that has come back into the market. And so from my mind, or from my lens, it seems demand is continuing to rise, and it will only continue to rise as clients look to offset those costs. And as I'm sure everyone's aware, when the truck market tightens, intermodal goes from, this optional lever to pull to a very strategic lever, and it happens very quickly. And that's what's happened this year.
Yeah, we talk about LTL having the same, benefiting from some of the same tightness. Intermodal did well even during the freight recession, but it is, we see the rail data that comes out once a week. It will come out tomorrow. Intermodal volumes are just up substantially year over year. And that's only, it feels like, in the last couple of weeks. Is it because shippers are looking at fuel and saying, hey, the intermodal fuel surcharge is much more advantageous? Is it just general tightness that's driving more use of intermodal?
Yeah. Good question, Craig. From, again, where I sit, it's sort of this three-pronged problem or opportunity, if you will. You have fuel on which we all see at the pump every day, and we know that's been this historic rise. It's $2 more than it was a year ago per gallon. Additionally, you have some of these pressures that have happened on the for-hire driver market where, the non-domiciled driver rule, the English proficiency law. And so you have these things that have been sort of detrimental to the long-haul, over-the-road workforce where, and additionally, where it becomes, I guess, opportunistic for clients who move those specific lanes to put it on the rail or ideate on using the rail as a lever to offset costs. And then additionally, I think what's happened is you've seen import activity sort of consolidate into Southern California, speaking specifically off the West Coast, because I'm sure it's on some folks' mind as we potentially have a peak season. But that import activity has really been, condensed into Southern California. And additionally, most of that long haul freight then is coming out of Southern California, further exacerbating some of the over the road segment and those rates that they're seeing climb so quickly. The other component of this, and maybe the third or fourth, is the fact that data centers and oil are also propelling the economy in such a way that some of the Gulf Coast and East Coast activity has risen in a fairly abnormal way. Whereas the atypical rise in Southern California is really what we would be looking at this time of year, but we're noticing it in other spots too.
So you're reading my mind. I was going to ask next if you think there will be a true intermodal peak season off the West Coast this year. Sounds like you do. Tell us what you expect.
I do expect it. From the lens of a shipper, for those folks who have planned ahead, and have developed an allocation, meaning that they're shipping a certain number of containers each week, and the railroads are planning ahead for that. If you aren't one of those folks who has done that, I think try to do that quickly. There's little time left. As I mentioned, most of our
surcharges,
avoid them as best you can. You got it, Julie. And so from that lens, the shippers who are maybe more mature or have been doing this as part of their strategic lever for a period of time, they should find themselves still, able to have the capacity to meet their demand. For those folks who are maybe nuanced to it, I would encourage them to look at it as an opportunity to reevaluate what needs to move truck versus what might be okay moving rail. And sometimes that comes with, actually more often than not, that just comes with internal discussions around the folks you're nearest to ensure you understand your customers. Because quite frankly, I do think it's going to be a challenging environment in Southern California. We've noticed an uptick in outbound Southern California moves over the last, coincides with what Craig said earlier, the last 6 to 8 weeks. And so we think that challenge will persist through the rest of this quarter and potentially through all of Q3. But what's unique about this peak season is it's not just driven by the import activity. It's really driven also by that over the road contingent that is coming back to the railroad because that economic advantage has become so wide.
Yeah, Julie and I talked about this pretty extensively, and we've talked about it on FreightWaves, is the idea that it used to be that the coast would sort of drive the freight market, or at least that's been the way it is over the last 10 years, is you'd see freight end up in the port cities and then make its way into the Midwest. And what you're talking about and what we're seeing in the data is a complete flip in that, where the Rust Belt and that, I like to say, I-35 corridor down to Texas, that is the part of the country that's pumping freight. But I am curious, as an intermodal lead at Echo and an intermodal provider, that is a big difference than what traditional intermodal has played in. Traditional intermodal has played cross country. How are you guys positioning yourself to take advantage of those opportunities?
Sure, that's again a good question. I think you're referring to some of these tweener lanes, as folks maybe refer to them, like, it can move truck. The rate for truck is comparable to rail. If the rate for truck is comparable to rail, do I really want to put it on the railroad and have it sit for an extra day potentially? And so that logic that maybe persisted again through the recessionary times of post-pandemic era, I think what's happening today is more clients are looking at intermodal and saying, hey, do you have the capacity to move it? I just need 53 feet of space. And it's a little bit of a return to what we saw during the pandemic, where if you had the capability to move it, the client sometimes didn't care, just the fact that you could make it happen. And I've talked about this, maybe I'm overdue with saying it, maybe I said it too early, but I've been saying this for a number of years, that it seems like the world has changed a little bit over these last several years, where we care less about how we receive the freight, but when we receive it, if it's on time and in full. And I think that the world has changed quite a bit in terms of supply chain planning specifically over the last 10 years. We have a lot of tech. AI advancements have made it possible for visibility and predictive analytics and so on and so forth. So with those sort of tweener lanes, planning appropriately, having the visibility, having the communication behind it, intermodal is offering an offset to those clients that's allowing them predictability, a finite cost to doing business without playing the spot market that seems incredibly volatile right now, especially in some of those mid-haul lanes. And then additionally, the capacity that they so desperately need to move their goods into market.
Dutch, I remember when U.S. Express rolled out an intermodal business in 2002, and we were embarrassed to tell shippers that it went on the rail. It was sort of like a hush-hush thing, and a lot of shippers were like, please don't put... It was TOFC, so the container, the freight never moved out of a container, it stayed on the trailer. But I would imagine that's shifted, where shippers are, particularly in a tight capacity market, just want it delivered from point A to point B, undamaged and on time. Is that a trend that's continuing to gain importance?
It is, and maybe I'll go back to where we started, with the cost, right? Cost is typically what drives consumers to rail. They see truckload costs rise, suddenly they look to rail to reduce that pressure. And I think that's still very similar to what you just described. We're seeing a lot of those cost pressures drive folks to make these decisions and live with it. And seemingly, what I would like to hope will happen is that this economic advantage will persist and we can have some stickiness on the railroad so that it's not just a one-time thing, but clients incorporating this into a consistent part of their supply chain so that, potentially in a year from now, if they see another peak, they're able to offset it because they have planned ahead effectively.
Julie, when you were at US Press, did you guys use a lot of the rail?
I was over all of the intermodal pricing for a long time.
And was it a big piece of the business?
It was. We discontinued it while I was still there.
Did you have customer service people who were like, "Don't put my freight on rail"? Was it a big piece of it, or
No, I think we had worked through that. I think we hadn't worked through necessarily how we communicated it and fuel surcharge to our customers and fuel surcharges. But I think as long as it was getting there without adding transit days, we were all pretty comfortable with that happening.
I had to set up something called Rail Hell, this is when I ran Express Direct. By the way, I'm so glad FreightWaves was not around there. There would be story after story of the stuff that we used to do to move freight. Rail Hell was the idea if you didn't put a number of truckloads on the rail, you would have to work on Saturdays. HR did not like that.
Was that before the rail capture program was created?
Yeah,
just automatically captured the freight that could go
That was no automatic capture. The customer service reps got to decide what freight went on rail, and of course, none of them, they all wanted to use it on truck, but that's changed. I mean, we're talking 2002, 2003, when rail was just sort of coming of age of sorts, and there was still a lot of apprehension because I think shippers remembered the 90s and they remembered the disaster that was the railroads. But that's changed. I mean, look, I was born a trucker, multi-generational trucker. I've said in my next life I want to come back as a railroad tycoon's son because those businesses are amazing.
You hit it spot on. I would also come back with you. By the way, if you have a brother, glad to be your brother.
You'll be my brother.
But from the lens of what goes on the rail and clients, I think visibility for clients is we have reached a degree of visibility where clients could quickly deduce if that's on the rail or not from the movement of the freight to where it's. There aren't roads necessarily in the middle of nowhere, Nebraska and Missouri. God bless those states, but typically, if you're creeping down 55 or over on 40 or 80, you're going to be pretty visible. But if you're on the train in the middle of nowhere, I think folks are going to catch on pretty quickly. And so I certainly don't. I don't want us behaving in that way, and I haven't seen it thankfully here at Echo. And so what I would tell you is that we're doing some great things for clients to help them find solutions to offset some of these costs that they are incurring, because man, you say, I'll say freight hell, because it seems like a lot of folks who are in that shipper world are living through a little bit of a freight hell as they think about the conversations they're having with CFOs and CSRs and everybody else in between about rising costs, because they are real.
Dutch, I'm just trying to make up for all the things that I did wrong when I was in freight and calling people out and confessing. This is sort of like, when you did something and you get caught and you sort of become the spokesperson for what not to do. We did all sorts of things. That's why we know all the games that are being played. There's always a new game. Look, I have to ask, back in 2003, when the freight market was absolutely tightening, very similar conditions to what we're seeing right now, the railroads got very aggressive with rate increases. You talk about middle of nowhere. BNSF took us to Montana. No lie, we were in Yellowstone Park. They shut down the train. It was supposed to be a nice glacier through Glacier National Park, and then they asked for a 10% rate increase in middle of the park. I didn't know if we said no, if we're just going to be dumped out there and have to walk, hundreds of miles. What are you seeing the railroads do right now, Dutch?
Yeah, it's funny. That's a great question of all the questions. Honestly, thank you for asking that. I have had the opportunity over the last couple of weeks to listen to the CEOs of both railroads, Western railroads, speak. And as we all know, there's two big things happening in our world. And one is the potential for a merger, and the other one is quite frankly, the potential for not a merger. And so that's really what the two sides are up against. And so when I think about rate increases and things like that, I don't necessarily think that the railroads are competing against each other, as crazy as that may sound. What I think the railroads are really doing is optimizing their network and trying to right-size their prices based on what's happening over the road. typically that's their barometer for what they can get away with, so to speak. And so from that lens, what you're seeing in over the road will most likely follow in intermodal. Fortunately for shippers, what happens in intermodal typically trails truckload by 6 to 8 weeks. They want to see what the folks in the rail world want to see what happens in truck, and then 6 to 8 weeks later, they'll typically react. And that, I will say, that time has contracted a little bit over these last few years as we've gotten smarter and advanced learning has come into play. And so I do anticipate rate increases, in the near future. What I don't anticipate is any sort of, hey, we're going to break down a contract and we're going to, negate that and wash it, and we want to reset it during mid-cycle. The railroads are honorable folks. They do it. They obviously have a long amount of business experience in that they can draw on. But they're also going to be advantageous when it comes to price increases. And I do anticipate the rates will increase over the course of the rest of this year based on what we're seeing in demand, and also capacity becoming outstripped by supply or by demand.
We have these charts inside of Sonar. I know Julie and I've talked about it. Is this the spread between trucking and intermodal? Intermodal has been much slower. You talked about it just being, weeks, if not a couple of months behind contract rate. It hasn't even moved that level. It seems like intermodal is a fantastic savings for shippers, especially as fuel prices go up. The fuel surcharge is more advantageous. I've got to get your thoughts on the railroad merger, because you mentioned it. One of the interesting things, we had Bill Stevens on last week where he talked about the fact that the railroads in their application are not talking about competition between other railroads. They're really talking about competition between trucks. What's your thought in terms of the railroad merger? You have any belief on whether this ends up happening? How are customers reacting to it?
Sure. So far as prognostications, I'll maybe stay away from that because it's probably above my pay grade, and I think there are smarter folks than myself when it comes to the regulation impact on all of this and how the government views it. But the two things I think that folks need to understand is that really this is a decision based on really, does it enhance competition or not? There's arguments on both sides of it. You could argue it doesn't enhance competition on one side, and you could argue that it does on the other. And both Western railroads specifically will do that. But the other piece that I think folks need to understand or think about, at least in terms of just your common life, will this speed up or make the supply chain better? Will this forcibly make us improve as an industry? And I think those are two considerations that are going to require a lot of thought leaders to lead the charge on. And I think it's going to take some serious consideration from the government on the notion of the competition piece. And so, a smarter person than myself will probably make that determination. But those are the two things when I measure this, potential for a merger. Those are the two things I explicitly look at. And I think there's still a lot of work yet to be done on both sides to convince me one way or the other.
Yeah, I think there is a really solid argument to the fact that intermodal does become more competitive with truckload, because you do get cross-country intermodal. I don't know that it benefits the bulk shippers. We've obviously seen the chemistry association really push back, and some of those bulk shippers push back, rightfully so perhaps. But there is a real solid argument. I do think it's interesting. Union Pacific rolled out a new train. This is a part of the America 250. Really smart on their part, by the way, is put 4547, the Donald Trump train. If you followed anything in American politics, putting Donald Trump's name on something ends up getting you some votes. I thought that was, whether you bbelieve this is a good thing or not, it's kind of brilliant if you're trying to influence the one person that can make a big difference. Yeah. I mean, it's not a bad move, because this merger will be decided by the president. What's that?
I'm not touching that one. I'm not adding anything to that.
You're going to stay away from that, Dutch. You're a smart man. You have a lot to lose. That capacity is really important.
Republicans, Democrats, and independents, we want all of your business.
As I think Michael Jordan said, Republicans buy shoes as well, right? And then
that's right. Everyone. Yes.
Who was it Snoop that said when he was asked about it, also said white people buy rap songs, because he was getting a lot of heat from that? This is back in the day. So anyways, great to have you here, Dutch. Appreciate you coming in. A lot is going on at Intermodal. Are you an Intermodal fan? Are you a rail fan?
I am. Early in my career, I did all of the pricing for Intermodal for US Express, and I was like, dreamed I'd get to work at a railroad one day when they had pensions and all of those things.
I think it's cool. We have to do a remote. We need to go to a rail yard, perhaps in Joliet. Maybe Dutch will invite us up there just to actually do a live remote from the Joliet yard. So Dutch, I hope you have us up there at some point, and great to have you on.
We're going to have you on during the summer. Thanks a lot again. Congratulations on the show. I really appreciate the opportunity to talk about the market with you all.
Appreciate it, Dutch. Thank you so much. And next up, we're going to go to break. And then right after, we're going to go to John Kingston, who's always got the hot take. He is our oil and energy reporter. He's going to talk a lot about not only oil and energy, but what's going on in the broader trucking market. He is the man with the stories.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The map is changing. As global uncertainties rise, the future of the supply chain is moving closer to home. Welcome to the new coast-to-coast North American network. Driven by massive reshoring trends and next-gen industrial innovation, optimized by AI workflows that build unshakable operational resilience, and locked down by proactive security against evolving freight fraud. Are you ready to navigate the shift? Join the industry's top minds to build the future. The FreightWaves Domestic Supply Chain Summit. Streaming live June 17th. Register for free at live.freightwaves.com.
Welcome back. We're going to hear one more quick word from our sponsor, Loves, and then we will be back with the one and only John Kingston.
In today's freight environment, every second of uptime matters. Of course, maintenance is inevitable, but large fleets cannot succeed on reactive fixes alone. That's why Love's Truck Care delivers smarter preventative maintenance. Love's understands that operational pressures demand a nationwide service network for better visibility, actionable intelligence, and consistent execution, all of which you protect your assets, reduce your total cost of ownership, and maximize your uptime. Maintenance is, of course, inevitable, but large fleets cannot succeed on reactive fixes alone. That's why Love's Truck Care delivers smarter preventative maintenance. Learn more.
All right, welcome back. We are joined by FreightWaves Editor-at-Large, John Kingston. John, always good to have you here. Thanks for being here today. OPEC numbers are out. Can you talk us through what just dropped and what the headline numbers are?
Yeah, we'll talk about the Department of Energy Information Administration weekly price, which of course is the basis for most fuel surcharges. It was down 14 cents. in a week. That's a lot. I would usually say that's a really big number, but things have been so volatile. Even 14 cents up or down doesn't seem that crazy anymore. Anyway, it's at 521. It's the third lowest price since the Iran war started. The first two were in the first 2 weeks after the Iran war started. So, we've come down quite a bit. We're down about, 43 cents or something like that over the last 4 weeks. Interesting thing there is just to show you how crazy it is out there. The AAA, the AAA average daily retail price, they come out every day. That's why it's daily, is like 10 cents higher. They're usually right around each other. But the AAA price is 10 cents higher, more like 531 around there. But anyway, the trend is very clear that it's coming down. The price of ultra low sulfur diesel on CME is down like 8 or 9 cents today. So we've got a further trend. And meanwhile, you have this fairly large chorus of people out there that do not understand this. They're looking at this term. We talked about it last week. Tank bottoms, the idea that inventories are starting to, relentlessly move toward a level that is really the bare minimum that the system needs to operate. After that, you really can't draw on stocks to just meet demand. What happens then? We spoke last week, but it still continues to come up in these discussions about the two executives, one from Chevron, one from ExxonMobil, who spoke at the Sanford Bernstein conference about a week and a half ago. And they don't normally talk about price, but they did this time. They talked about how we were moving toward tank bottoms, and the impact on price was almost certainly going to be bullish. So there's this real dichotomy out there of the actual numbers of paper barrels, which are what are traded on these exchanges, which are going down, and some of the physical prices out there, which continue to stay very high, and in fact are going up, and the prediction that things will get even tighter. There is and I put this in the story that's on FreightWaves.com today. There is a theory, not a theory, I shouldn't say, but an observation that the market is in what's known as backwardation. And in backwardation, the first month price is the highest, and then the second month price is a little less, and the third is a little less than the fourth, and so on. It's a situation that is the inverse of a perfectly balanced market. It's something you get when inventories are really tight. And as a result of that, the view here is that even though a lot of people think prices may be going up because of these tank bottoms, well, then why don't they buy oil 6 months out and then watch it rise over the next 6 months? And one of the reasons is because if you're, let's say, a commercial entity and you want to hedge, by doing that, you've got to put up more collateral. And what happens if you're wrong? So, you have to you be buying the out month and selling the front month, and you're going to lose money right away on a mark to market. So the idea here is that the backwardation is making it very, very tough for companies or companies or traders who truly do think the price is going to go up to step in and buy. So a lot of logic is kind of out of the market right now. And, the tank bottoms are talked about like sometime for July. The bottom line is the market has adapted pretty well, but how has it adapted? It's adapted by draining inventories. And the U.S. inventories, total crude and products last week, were at the lowest level they've been in 2 years. They've been down like 7 weeks in a row. Yeah, so there just seems to be some kind of, we're kind of coming to some kind of a head in the next 4 to 6 weeks that will really tell us a lot.
So lots of different data points coming into this, lots of almost sort of counterintuitive arguments, I would say, from what some of us would think. How does this ripple into diesel prices, carrier costs, freight rates?
Well, freight rates, as we know, in Sonar, we've got numbers that show the freight rates without diesel and the freight rates with diesel. This industry has done a pretty good job of taking diesel prices and using the fuel surcharge to push that onto shippers. But of course, if you're an independent owner operator, and you're just getting spot loads here and there, you're probably not going to have a fuel surcharge. This is the kind of market that's really good because presumably you booked a rate maybe, 2 weeks ago, 3 weeks ago, with the assumption that diesel was going to be X, and it's a falling market, so diesel is going to be X minus something. So that can be pretty profitable, at least in the short term. So for independent owner operators, this kind of market is good if you're not in a position to put that through your your fuel surcharge because you don't have one. I have always read that in LTL particularly, I mean, you would think that the model, the economic model of a fuel surcharge is it shouldn't affect you either way. Well, that's a textbook definition of it. In the real world, it does. And that rising diesel fuel surcharges actually does help the what I call the purveyor of that surcharge, basically the carrier, in particular LTL carriers. So you've got a decline here going on, and generally that is not good for the trucking industry. Again, perfect world, it shouldn't matter, but it's not a perfect world.
Well, it does matter. You're exactly right. And we talk about fuel all the time and everyone says like, oh, it's all in the fuel surcharge. Well, it's not. You know, freight is not based on costs. Those rates are based on supply and demand. And to your point, so much transactional freight is bid as all in. Gosh, if there's a carrier or broker who, to your point, 3 or 4 weeks ago booked a project that goes through this month and they quoted it all in, they are in great shape. But the reality is the market has been tight enough where carriers have been able to increase their all-in spot rates enough to cover the cost of fuel because demand has been there and supply has been tight. If it were a different rate environment and the pricing power was more on the side of the shipper or the broker rather than on the side of the carrier, they wouldn't be able to recoup the fuel costs. They can because the market is tight. So I think it's always an important factor to talk about that. Yes, it is a cost for them, but it also isn't the only thing driving rates in our industry. So
right, and
all of I'm sorry, go ahead.
I'm sorry, I was going to say, when I look at some company earnings from the truckload carriers, they will quote a figure for empty miles. You know, the LTL carriers are the dedicated operations of an over-the-road carrier. The number of empty miles is pretty small, but for a lot of truckload carriers, I mean, they'll have, 10, 11, 12% empty miles. Obviously, there's no fuel surcharge tied to that. So there's a benefit here.
Definitely. Tell us what shippers and carriers should be doing with the information, all of this information you gave us. What should they be doing with it right now?
Ooh, good question. Holding on for dear life? How's that going?
We all are, right?
No, it's so volatile. In my story that's in FreightWaves today, I put in a tweet from a guy named John Arnold, who is a kind of legendary trader. And he's just in that tweet lamenting that everybody seems very calm, given this still, the reality is there's still this gigantic loss of supply, which we've been able to cushion through a lot of things. Some of it's through demand destruction. Some of it is from strategic releases. Others are just by private inventories being drawn down. But as the great late economist Herb Stein said, if something can't go on forever, it won't. And the belief out there is that the conditions that have allowed us to go on like this, obviously we've got higher prices, cannot go on forever. And the end is maybe near, this month or next month, when you're just going to have exhausted your strategic stocks, when you've exhausted your physical stocks because you just cannot drive those stocks any lower and still expect your system to work. So I just would say don't get too complacent. I don't know how much they can do about it. If they've got a fuel surcharge already, that's great for them. If not, I just don't know what you're going to do to protect yourself. I mean, nobody's going to go out and hedge in this.
No, it's certainly too uncertain. All right, so we hear where it is at today. We don't have a good idea what's going to happen yet longer term, really a lot to watch over the next couple of weeks. If you had to boil it down and make a guess or a bet, what would it be?
Well, I normally don't like to predict prices because I'm terrible at it, but I'm going to go with what I told you last week. Those comments by the Exxon and Chevron executives, in the case of Chevron, it was Mike Wirth, their CEO, were startling, not just because they predicted higher prices, but because they don't like to talk about prices, period. Those companies they will tell you, and I think accurately, they may have economists who can do all these models about where prices are going, and they can be completely wrong. But for them to stand up there and talk about prices publicly, when there is always that concern about antitrust, and both of them predict, pretty clearly that they thought that prices were going to go higher, I just think that is really concerning. And so I'm kind of gonna stick with them. Their prediction were higher prices that'll probably start sometime in July, And I'm going to rely on them, given their perspective, given everything they know about what they've got in their system. And their systems are big enough to be, I think you can extrapolate what's going on in their system out to broader companies. And I would say, if anything, just because they're kind of more responsibly managed, they're probably in better shape than anybody. So if they're worried, that should tell you what's going on out there.
Well, John, you are probably one of the smartest men I know. So for our viewers, what else do you think they need to know on this topic?
Well, I think you need to get out more if you think I'm one of the smartest people you ever known.
Come
but
on,
anyway, what else do they need to know on this topic? You know what? Let's watch for diesel again moving faster upward than crude. I don't think you can necessarily expect a straight line. That if crude goes up 5%, that diesel is going to go up 5% as well. We've always had a couple of problems. Number one, the crudes that come out of the Middle East are distillate rich. They do very well in terms of producing distillates, which are like diesel, jet fuel, heating oil. So the loss of that supply is going to be particularly hard on diesel. And I think demand destruction can happen easier in gasoline than it can in diesel. Companies are going to be loath to cut back their operations that are diesel driven. Gasoline, you can get demand destruction just from little things that add up. You know, people carpooling, people driving less, people driving a little slower. It's a lot tougher, I think, to get that demand destruction in the diesel market. So watch diesel relative to crude. I don't think you can assume a one-to-one relationship.
I think that's a really good call out to your point. I think regular consumers can change habits more easily and more readily, or not take the vacation that they were planning to take, whereas diesel consumers, carriers, people carrying the goods that we need to get to us every day can't.
Right. The other thing, too, is remember, as I said, jet is a distillate. Diesel is a distillate. If you start hearing a lot of stuff about jet prices and jet shortages, assume they will spill over into diesel eventually.
All right, great. John, thank you so much for talking through this super interesting topic with us and being here today. I am sure we will see you back very shortly, and always appreciate the information you share.
Okay, great.
All right, so it's been a great show today. We got to talk about railroads. We got to talk about AI quite a bit, and some of the consolidation that's happening in our industry. We also got to hear a lot about smart trailers from Phillips Connect. That was a great opportunity for us to hear what they are doing there. We had a whole group of really great guests, so I want to say thank you to all of them. We have a great show coming up tomorrow. I'll be joined by Malcolm Harris tomorrow, and we have a great lineup of guests. We have Mark Hill, the CEO of PCS Software, Brad Castro, the CFO of Goodyear Towing, Andy Ingardino, Managing Director of Transportation at Gallagher. And we will have our regular rail report with our sonar expert, our own Mike Bodendistel. Always excited to hear from him on what's happening with the sonar numbers, and then in general, what's happening in the intermodal markets. So it'll be great. Thank you guys for tuning in today. We'll see you tomorrow at noon. Be sure to interact with us on social media, #FW Today.